Welcome to Real Estate Radio Power Investing, an informative and engaging hour discussing everything you need to know about the world of real estate investing. Your host, Tom K. Wilson, provides you with insight and guidance from his years of experience as a successful real estate entrepreneur on how to buy, sell, finance, and invest in real estate, and much more. Now, here's your host for Real Estate Radio Power Investing, Tom K. Wilson.
Nice to have you back with us on Real Estate Radio Power Investing, where we empower you with the education to maximize your investing success. We're broadcasting from our Wilson Investment Properties headquarters in Silicon Valley. I'm Tom K. Wilson, your host for the weekly program on real estate investing. If you can't make the live show, you can catch our podcast on TomWilsonProperties.com or on iTunes or on YouTube. And you can go to TomWilsonProperties.com, the website for Wilson Investment Properties, a sponsor of this program, and sign up for our newsletter that gives you a weekly update on what's going on in news and real estate and economics that impacts real estate, which is just about everything these days. And also by signing up to that, you then initiate your relationship with us so that you can get access to our commercial syndication products that allow you to buy shares, typically at $50,000 a share, and industrial grade and high investor level products that normally only those folks can get access to. And we a lot of information and education on our website. And also want to indicate that we've got a club called Baycom.club, BACOMM, Bay Area Commercial and Multifam, and it's now in our fifth month. And we encourage you to sign up for that. It's a different from Wilson Investment Properties, although we sponsor it. It's an education event. And this coming, if you're listening to this before May 24, 2018, then want to encourage you to come to that event because our guest today, Dr. Doug Duncan, Chief Economist of Fannie Mae, will be speaking and giving his latest input on his forecast. So you don't want to miss that. So go to Baycom, BACOMM.club, and you can sign up for that event. So we do indeed have today back with us Dr. Doug Duncan, who's been kind enough to come out and give presentations to us and stay in touch with us and be on radio shows for at least 10 years now. And Doug is the Senior Vice President and Chief Economist of Fannie Mae. He's the one that provides all the forecasts and analysis on the economy, housing, mortgage maker markets of Fannie Mae. Named one of Bloomberg Business Week's 50 most powerful men in real estate. He's also won awards for being one of the most accurate forecasters. Before that, he was chief economist at Mortgage Bankers Association for 7 years. His doctorate's in agriculture economics from Texas A&M, and proud to be an Aggie. And we welcome you back, Doug.
Thank you. Glad to be back.
I guess last time we saw each other was in Fort Lauderdale, where you spoke in front of Summit at Sea at the Real Estate Guys sponsored event. Had a pretty nice audience there. That was pretty nice interchange, didn't you?
Yeah, it was a good group of people and a lot of interaction, which we really enjoy. So that was fun.
We're going down. We fly down on Sunday to do a interview with the real estate guys on commercial and industrial products. So we're looking forward to that.
Yep.
So Doug, let's dive into some meat here for our listeners. I think I'll start off with asking you about this. I see that the Home Price Sentiment Index, HPSI, which I believe it's called, is at an all-time high, while more consumers also believe that now is a good time to sell. So we kind of have this contradictory metrics to some degree. So what does this indicate in your mind?
It's excuse me. It's interesting. We call it HPSI, Home Purchase Sentiment Index. It actually comes from our survey of 1,000 consumers monthly, and then it's focused really on housing. Some of the other consumer sentiments, like Michigan and the Conference Board, are broadly cast, but we kind of refine things down to what do people think about housing. And There's two things going on, I think. One is people can see that the housing sector is healthy, again, post-crisis. They see the very significant house price increases that we've seen, which have been running at about 4 times the normal level from an inflation-adjusted perspective for maybe 5 years now. And so if you own a home and want to sell it, you will have a significant equity accumulation. So that would be a reason why somebody might say it's a good time to sell.
Take some money off the table.
If you're a renter, you're looking at the increase in interest rates recently and also that real strong house price appreciation. And you might be a little more skeptical about whether it's a good time to buy, but you would probably also recognize that if somebody owned a house, it'd be a good time for them to sell. So it's an interesting juxtaposition of views. We actually teased out of it renters only. Actually, I had the staff subdivide that index into different groups. And what's interesting, and I'm not sure I can explain it, is that renters have very similar attitudes about the housing market to people who own their house outright. People with mortgages have a little different.
What aspect of attitudes?
Well, the index itself, which captures those 6 questions. So if you calculate out the index and then you plot the index for renters and people who own their house having paid off their mortgage or never had a mortgage, their attitudes track each other very closely as measured by the index. The people who have a mortgage have actually a little stronger view. So in other words, the index has a higher level for people who have a mortgage. And I think what might explain, this is just speculation on my part, but what might explain part of that is people who have taken a mortgage and bought a house, they're maybe at a mid-career kind of a place. So if they're a first-time buyer, they're an older millennial, say in their mid-30s. And you would typically have paid off your mortgage by the time you got to say 60 or thereabout. So the people with a mortgage are probably more in their prime earning years, and things look pretty good because unemployment is low. They're seeing income gains, all those kind of things. So that may be the difference between the renters and people who own their house outright. More people who own their house outright are at or nearing retirement age. So there's probably a differentiation there.
Okay. Interesting. Very interesting. Let's talk about, while we're on that aspect of housing and let's supply, demand, and appetite for buying and selling. Let's talk a moment about housing starts and why you think we still have such a supply shortage. What do we run about? Demand of 1.7 million and we're supplying 1.2 or 1.3?
Yeah, it depends on whose estimates of demographics you use. Our thought it's more in the 1.5 to 1.6 range, and we're at about 1.2. So we're thinking somewhere in the 300,000 less units, depending on which estimates you use, could be anywhere from 200,000 to 400,000 units less being produced than what current demographics would suggest, and that includes both rental units and owner single units or owner occupied targeted units. If you separate them out and you look at the production of apartments, it looks pretty close to being back to normal. So it's really on the production of single-family homes that the bulk of the shortage exists. What are the reasons for that? Well, there's a variety of reasons, but most of them have to do with cost. It could be the land cost, that is just buying the raw land is somewhere in proximity to where somebody that could afford a house that you built on it could get to work reasonably. So that's a challenge in some markets. I think you're San Jose, San Francisco area, that's certainly a challenging issue there. Even if you can get the land, getting it through the permitting process can be very time-consuming and costly. So all of that is expense that's incurred by the builder and or developer even prior to starting the construction of the house. So given that those things are higher really anywhere across the country than they were prior to the crisis, the starting point for an entry-level house is at a higher price point than it was, which means affordability would be an issue. And, of course, builders don't build houses unless they can sell them and make money. That's what they're in business for. Pretty rational. So then you get to the actual construction of the house, and the number one thing that they cite as a problem is access to skilled labor, and that's consistent pretty much anywhere, any of the surveys that you look at. Now, if you think about supply, and if all the builders are saying, well, now employment is spread out across the country and there are jobs growing in areas where land costs less, now I could start building, say, you mentioned, I think, Cincinnati or one of the second-tier cities from a size perspective, but where the economy is doing okay. You still have to have the labor to build it. And if all the builders are trying to expand at the same time, you would expect surveys to represent that that access to skilled labor was an increasing problem, and that's exactly what's happening.
Yep.
So so that goes into the cost of the house. And there's a limit to how far you can raise wages to try to attract the worker and still be profitable in building the house.
Sure.
So wages in that space are back where they were prior to the crisis.
Right. And so real briefly here, we have about 30 seconds left in this segment. What's 45 seconds is the you've been a proponent that it's been a misnomer that millennials don't want to buy houses, and that boomers are shedding houses, and it's really not happening. Have we crossed the? It's really the opposite. Millennials are buying now, and boomers are staying in their houses longer because they need the income. Have we crossed the bottom of home ownership?
Yes, I think we have. The last couple of measures of that have shown stabilization, so I think we're there. Of course, if we hit a recession, that might change it temporarily, but I think we're there. The millennials are driving the demand curve today.
Okay. We have Dr. Doug Duncan with us today, Executive VP and Chief Economist of Fannie Mae, talking to us about housing in the United States, the different metrics and pressures that are affecting it. And when we come back in just a moment, we'll ask him some more questions about where things are headed, how's financing, and so forth. Stay with us here on Real Estate Radio Power Investing.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
We have Dr. Doug Duncan with us today, Chief Economist of Fannie Mae. We're talking about how You concur, Doug, that your surveys are showing that millennials are starting to buy, and that boomers aren't shedding houses as quickly as they used to in this category, and they're staying in houses longer. Is that true or not?
Yeah, that's right. We've produced some data that show for the last 3 years, the share of millennials who are forming new households and going into rentals has been falling, and those going into owned homes has been rising. So that's been underway for about 3 years now, which lines up with what their parents were telling us back in 2013 when we surveyed them about the older kids living at home. We asked them, do you love them? And if so, for how long? And they said, we do, but for 2 to 5 years. So we're now out at that 5-year time frame going into 2018. So they're doing exactly what they suggested. The boomers are also doing what they suggested, which was we intend to age in place and fix up the home because we want the kids to come home and bring the grandkids. So the boomers are actually driving the remodeling market. If you look at the remodeling business, you'll see that they're tapping some of that $6.5 trillion of equity they have in their homes, and they are, in fact, remodeling. It goes back to the question we were talking about earlier about the supply of new construction. That's actually one of the reasons that the builders of new homes are having difficulty getting skilled labor is the productivity of a skilled worker in remodeling is lower than it is in single-family homes and lower than it is in apartments. It's actually, the productivity is actually least there. So the fact that the boomers are paying up to get the remodeling done is attracting away some of the labor from the builders who would do new construction.
New construction, yeah, interesting. And I'm a good example. I've been in my home for 24 years, and many of my listeners know that I lost my wife recently, and so a lot of people say, well, I guess you're going to scale down and move and so forth, and no, I like it where I am. I don't want to jump. I got a low tax base. I like it here, and so what am I doing? I'm remodeling, so I'm in the process of that. So I'm kind of typical of that demographic, I think.
Yeah, a lot of that in the D.C. area as well. I was just talking to a group here this morning, and of the three people I was talking to, two of the three were doing a remodel for very similar reasons.
Mm-hmm. Okay. Many of our listeners know Bruce Norris, our mutual good friend. And of course, Bruce has promoted a lot in the past cycles about affordability index being a key metric, leading indicator of what's going to happen, and a predictor of what's going to happen with the housing market. In most markets, in spite of high prices, the affordability index is still reasonably healthy. Would you concur? And if so, do you think that's still a worthwhile metric, or not so much anymore?
It is. We divided the household income by two-income households and one-income household, and then compared across markets to see the relationship between that income measure and house prices. And what you find is that for two-income households, the relationship of their income in their market to housing costs is pretty close to normal. It's a little bit elevated, but pretty close to normal. So the real challenge is in single-income households. It's well off of what would be an affordable space. So that's going to be more of the story. The overall affordability, because interest rates are still quite low, even though they've moved up 50 or 60 basis points from a long-term historic perspective, they're still quite low. If they continue to move up and you still continue to see 6% annual house price appreciation, then you're going to see those affordability measures decline.
Okay. We got to take a break here on Real Estate Radio Power Investing. Got Dr. Doug Duncan with us, Chief Economist of Fannie Mae, and when we come back, we'll ask him about what's happening to the lending market, and what about the trade war? What's the impact on our economy for that? And some more questions. So stay with us here on Real Estate Radio Power Investing. We'll be right back.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
I want to remind you that if you'd like to hear more about Doug's insights and forecasting, he will be speaking on May 24, 2018, if you're listening to this prior to that date. in San Jose, go to BACOM, BACOMM.club, and sign up for that. Doug, we got interest rates rising a little bit. So first of all, isn't it a misnomer? A lot of people think that when rates go up a little bit, it shuts down real estate volume and velocity, and that's really not the case, is it?
No, it does slow down refinancing activity, obviously, because refinancing is really pretty much an interest rate play. It depends on what your current rate is compared to what the market rate is. So,
as far as demand for housing.
Yeah, as far as demand to buy houses, it really depends on the degree to which rates rise and the time over which they rise, and whether that's significantly out of sync with the growth of incomes. So if incomes are growing at roughly the pace that rates are rising, then the increase in income covers the difference in the interest cost for the mortgage. So housing does.
So the
fine.
affordability index essentially stays about the same.
Yeah, that's right. And so what the market does not like is a significant rise of rates in a short time period. And we ran that experiment back in 2013 with the taper tantrum, with Chairman Bernanke saying they were going to eventually slow the pace of acquisitions in their portfolio. Mortgage rates ran up 110 basis points, or 1.1 percentage points, in about a 6-month period. And the beginning of 2014, home sales fell about 10% from the baseline. So it's really the amount and the time over which rates rise that causes the issue.
With that rate of rise, your income doesn't go up as fast enough to mitigate that, right?
That's right. And if rates are rising because the economy is expanding, usually incomes are expanding too, and so housing does just fine. If rates are rising because inflationary expectations are rising, housing still does okay because a lot of people look at housing as a real asset and a hedge against inflation. But if the Fed senses that and is tightening to slow economic activity, then income growth slows. And if you got rates rising with income growth slowing, then that does slow housing. And often that's why in a more traditional housing cycle, you see housing slow leading the economy into a downturn or a slowdown at least, because it's such an important sector of the economy.
Okay. Just got about 30 seconds here in this segment. Talking about lending. Is it continuing to loosen up?
In our quarterly mortgage lender sentiment survey this past month, we saw what looks to us like the end of credit easing. Fewer lenders reported easing credit terms.
Okay. However, we got these subprime loans are coming back, right, from small financial institutions?
We've seen a little bit of it here and there, not in big volumes yet, and a question whether that's going into portfolio, and those might be people that are in a local market that know them. It's not a broad-based thing yet.
Okay, it's not a major factor. Okay.
Right.
Dr. Doug Duncan will be back with us in just a moment. We'll ask him some more questions about trade war and what's coming downstream and what he's going to talk about at BACOM.club. This is Real Estate Radio Power Investing. Stay with us. We'll be right back.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
Dr. Doug Duncan, Chief Economist, Fannie Mae, will be speaking on May 24 in San Jose. It's a Thursday night in 2018. If you're listening to this prior to that date, go to BACOM, BACOMM, Bay Area Commercial and Multifam, BACOMM.club, and sign up for that. And Doug will spent a lot more time giving us his charts and forecasts and insights. So don't miss that one. That'll be, I think, one of the best real estate investment events of the year here in Northern California. So, Doug, let's trade wars. Is that something that's appropriate, or you think that's how do you think it's going to affect our manufacturing? Do you think the trade wars will help us or not?
Well, it's hard to get economists to agree on anything, but most all economists will agree that free trade is good. But most of them also recognize that while in aggregate both trading parties benefit, that there are distributional differences internally to each country that can be a challenge. And that's really what the discussion is in the U.S., is that some groups have benefited and others have not. If you think about NAFTA, for example, Milton Friedman used to say a good free trade agreement can be written on one piece of paper. NAFTA was something like 2,000 pieces of paper. So it's hard to argue that there isn't something in there that could have been done that would have been better for the U.S. So that's part of that discussion. And there's not going to be a massive war on that. The risks there are to agriculture and autos. With China, it's a different issue, really. The issue there is intellectual property and the theft of intellectual property. And this has been underway for many years. This is not just this administration's issue. You could go back and talk about the previous three administrations, at least, that weren't doing something about this. It's just come to a head now. There will be some tariffs in that space, but the bigger issue that underlies it is the intellectual property question. And it could be disruptive, but it would be more disruptive to China than to the U.S. because it's a bigger share of their national income than it is for us.
Yeah, I've read that there's more commerce every day that goes across the Toronto Bridge to Canada than there is that goes to China. That's what,
our biggest two trading partners are Mexico and Canada.
And very, very quietly, nobody talks about them. It's interesting. Cryptocurrency. What rate is that kind of creeping into our system, and what's your thoughts about that?
I've been watching it. I wasn't one of those people who threw some money in at exactly the right time and pulled it out at exactly the right time. Those are the ones you hear about that made a lot of money. You don't hear about the ones that lost a lot of money. My view has been that eventually governments were going to get involved. And you can't, because part of the issue with the cryptocurrency is the libertarian view that you would like to have a medium of exchange that the government could not manipulate its value. So, for example, our central bank says they target 2% inflation annually. That's essentially taking away 2% of your purchasing power annually. I could agree with a currency that eliminated their ability to take that from us. The problem is they're not stable, they're not mature, and there will be moves to regulate them, I am certain, and some of that's already underway.
Okay. To what degree is our dollar a petrodollar now?
A lot less than it used to be, in partly just because it's not long, and the U.S. will probably be the if not the biggest producer, certainly we're already one of the world's biggest oil producers, and we're now an exporter. So energy is an important component, but to me, one of the most significant things that happened globally in the last 5 years was the announcement by Saudi Arabia that they would be willing to sell what is their real crown jewel, their state-owned oil company. That was a very important signal about the ultimate expectation of the value of oil going forward, and I think changed a lot of things on the global landscape.
So how is it going to change things?
I think it was essentially their recognition that there is a cap on how far oil prices can go. And that comes from two or three things. One is this newfound technology to increase production from areas that were not thought to have oil availability. And part of what that does is it saves the oil in the harder to extract, things like deep sea extraction and places like that, the Canadian sands, oil sands, those places where it's more expensive. The fact that it's available cheaper elsewhere just makes those additional reserves going into the future. And then if you think about autonomous vehicles and the shift to, say, electric vehicles away from petroleum-based engines, that too can put a significant cap on the demand side. So I think it's a recognition that going forward, the value of that resource will be lower on a per barrel basis.
So you think a short and near term that we may continue to climb up to some asymptote, but there's maybe a natural cap on it because world demand will start to decrease?
Yeah, there will always be, as in any commodity space, there'll be ups and downs in the price, whether it's cyclical or because of geopolitical factors or drought, or it depends on what the commodity is. There will be variability in the price, but that variability will be around a lower average price, in my view.
Okay. Any predictions on where the asymptote is? $75.
I think that might be high.
Interesting. Okay, because we just hit 70. Okay.
Right.
Well, we got to end this segment, and we'll bring Doug back here in just a minute on for a wrap up on Real Estate Radio Power Investing. Stay with us.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
What a treat to have Dr. Doug Duncan back with us again, one of the most accurate forecasters in the country. And you do that with a little bit of help, don't you, Doug? Well, you got 40-some staff?
Well, the folks that work on the forecast directly, there's really only about 5 of us. But I do have about 40 staff. We have a bunch of other things, including strategic planning and technology, enterprise pilots, and some basic research functions. So I do have around 40 staff. But folks that work directly on our forecasting efforts, it's only about 5 of us. But they are great.
I was just going to say, not too many chief economists in the country, financial institutions, so forth, have got that kind of resource to help them figure out what's going on. And if you'd like to hear more of Doug's insights and his forecasts and so forth, and you're listening to this before May 24, 2018, go sign up for an evening with Doug. And that's BACOM, BACOMM, Bay Area Commercial and Multifam .club, BACOM.club, and sign up for May 24th. We'll look forward to having you back. So Doug, what are some of the things that you will be presenting on that date?
Well, we're in our forecast update cycle, so that'll be done and put out just shortly before I'm there, so I can talk through the changes that we will have made, if any, in the forecast outlook. We're kind of, to your point of some earlier questions, trying to understand consumer behavior. We're doing a little work on try to determine, are consumers still more conservative financially because of the Great Recession, which there's some evidence that they are, because even with the tax cut, the spending has not picked up and savings edged up a little bit. What does that mean for housing? We've the tax cut and the additional spending that Congress and the White House have agreed to suggests that deficits are going to be a lot larger going forward. What does that mean for growth and inflation? What's the Fed likely to do in response to those fiscal policy changes? That's something we're trying to think about. And I know you'll have some commercial people in the audience. They're trying to think about the recent data on bank lending and corporate debt issuance and how the changes in the corporate tax code might have impacted that. So those are a few things.
Okay. Well, that's going to be a lot. I'm sorry, Doug, to cut you short here. We got to unfortunately run out of time on this segment. So that will be a lot of great information that Doug will be presenting again May 24, 2018. Go to BACOM, BACOMM.club. And Doug, in spite of all of his responsibilities there on Capitol Hill, he does a wonderful job in representing Fannie Mae and getting out on Main Street to find out what's going on out there in the real world, so we can bring that back. So it's sponsored by Wilson Investment Properties. Go to TomWilsonProperties.com, sign up for our newsletter, and also a lot of information on there, and it allows you to have access to our products that Wilson Investment Properties presents. So thank you, Doug, for being with us, and we look forward to having all of you back on our next program. So remember, the only thing that matters is what you do next.